Good morning. It's Jeff Christian from CPM Group. It's about 10:50 on Friday, the 17th of December in New York. Recording this for later release at some point. This is part two of a presentation. The first part was how to effectively invest in precious metals. It's about 25 minutes long, and we released that on the 17th of December. The second part is, so what does cause the price of gold to rise? Both of these topics have to do with responses to these questions and comments that people have made to earlier videos. If gold doesn't, if inflation or money supply doesn't push gold prices higher, what does? And so we're going to talk about that. And first off, let's start. And I ended the first part by saying it's the wrong question. Investors should ask, what causes the price of gold to rise or fall? Because the price rises and falls. And if you're only thinking that gold prices rise, you've got some sort of bias or belief or expectation or desire to see gold prices only rise. And that kind of predisposes an investor to losing money. Yeah, we have a very good client of ours who's been our client in 1993, almost 30 years now. And he has made billions of dollars in a range of commodities. And he has an enormous position in gold. And he regularly says, on a certain level, I will be happy if I never make money on my gold holdings. Because if I'm making a lot of money on my gold holdings, it means the value of most of my other assets are deteriorating. It's an insurance policy. And as I said a few weeks ago, governments around the world are working very hard to help gold marketing groups provide them with reasons to tell investors, hey, you should have this insurance policy. So the answer to that question is that all of those things combined in a complex economic and financial system affect the price of gold, push the price higher and push the price higher. It's just that they don't affect gold the way a lot of simplistic analyses suggest they do. You'll hear people say, well, all you really need to know about gold is the dollar. Gold trades against the dollar, and it doesn't. You'll hear people say, gold, all you need to know about gold is inflation, because gold is an inflation hedge. It is, but it isn't. And the relationship between gold and the dollar and gold and inflation is much more complex than those simplistic comments and beliefs have. The best multivariate macroeconomic models that we've ever built or seen other people build for gold price projections have a lot of independent variables affecting the price of gold. Some 8, 12, 24 independent variables coming together to determine whether gold prices rise or fall with varying degrees of effectiveness and importance to determining the price of gold. I'll show you some data in a second. Replay of something from our gold yearbook in the first quarter of this year, and something that we've used for decades. One of the most prominent and respected econometric analysts who built a gold model and was highly respected for it, he started in the late 1980s. He had 33 independent variables. It's intense because what you then have to do is make projections of 33 independent variables that you may not be an expert of. Money supply, inflation, real GDP in the United States, in the EU, in the UK, in Japan, in China. You have to start making projections of all those independent variables to plug into your model. So 33 independent variables, a little bit high, 8 to 24, more reasonable. So it's complicated. And here you can see gold's statistical correlation, changes in real gold prices, inflation adjusted gold prices on a monthly basis, moving average basis, right? Inflation, look at the broad scope, just the top line, 1970 to 2020. We have it broken down into 1970, 1990. You can break it down into different periods of time. But if you just look at the top line over the last 50 years, inflation 9%. The trade weighted dollar negative 33%. The Dow Jones and the S&P negative 4%. T-bills and T-bonds 0%. You love that because from the idea of diversifying a portfolio, you don't want an asset that's going to go up when your other assets go down and down when your other assets go up. You want an uncorrelated investment. Sometimes they'll both rise together, sometimes they'll both fall together, sometimes they'll move in opposite directions, one way or the other. That is an ideal portfolio diversifier. So those zero correlations, those are great. And then you can look at different periods of time and you see different correlations. But this goes back to what I'm saying is the relationship between gold and each of those variables that factor into whether or not the gold price is rising or falling. The relationships are much more complex than, oh, if the dollar rises, gold will fall. If the dollar falls, gold will rise. Or if inflation is rising, it's 9%. Or if interest rates are rising, gold will go down. You can look at each one. In inflation, it's not just whether inflation is rising or falling, it's what levels it's at. 2% inflation going to 4% inflation doesn't really scare a lot of people into gold. 2% going to 8% will scare a lot of people going into gold. Just sort of where we are right now. Problem, spoiler alert, inflation going from 8% PPI last month to 3% next summer. That could be bearish for investor attitudes toward gold. Same as with the dollar. They're a third of the time they're moving in opposite directions. That means 2/3 of the time they're not. You want to trade gold off of the dollar, you see the dollar rising, you're going to sell gold, you're going to lose 2/3 of the time. It's a much more complex relationship. And what you find when you study it is that oftentimes gold's not trading against the dollar. Gold and the dollar are both reacting to the same independent variable. And same is true with interest rates. And the interest rates, and we've done a lot of presentations over the last year or two for these videos, and it's been in our books and presentations all over the world. You have to look at why are interest rates rising, how high are they, and what the relationship is. Because nominal interest rates, real interest rates, you have to look at the whole complex. So gold, what causes gold to rise or fall is a complex interaction of these factors and then other factors, political issues. You might not have inflation. You might have low interest rates. You might have a strong currency. But if you've got a country that's falling apart, people will be buying gold. So it's all of those factors. Buy gold as an inflation hedge? Yes, but with an understanding that the relationship is not one-to-one. You buy it as a currency market hedge? Yes, but you understand that what you're trying to do is find an uncorrelated denominator for your wealth and not necessarily trade one for one in a negative one to positive one. Financial market volatility and risks, that's a lot more complex. You can look at money supply, you can look at the growing debt. You say, these things are clouds that are forming on the horizon. And at some point, those clouds may be on top of us, and we may see periods of severe financial distress. We may see banks close. We may see other things happen. The stock market might fall. And that at those times, gold could rise in response. But at other times it couldn't. Also, like with the stock market, going back to the stock market, a lot of times what you'll see is gold will rise when the stock market's rising, because as the stock market rises, it gets to a certain point where people say, this is too good to be true. Stock market's got to correct downward. So it'll happen. And therefore, I'm going to take some of my money out of the gold, stock market and put it in gold. And you'll see gold rising in conjunction with higher stock prices. Political and economic problems, very big. And quite frankly, you know, our theme for 2022 is, if you thought that 2020 and 2021 were bad, wait till you see 2022. Economically, we think that it might not be that bad of a year. But politically, in terms of international politics and relations between the United States and China, the United States and Russia, the Islamic world, Russia and the EU, China and the EU, I mean, there's going to be a lot of friction in the political international politics. And there's going to be a lot of friction in domestic politics, certainly in the United States, but things are bubbling in other major regions and countries too. So politics and political unrest and uncertainty probably is going to factor in more than it has in the past in the gold market in 2022 and possibly for several years. And as a form of savings and as a commodity. So those are the things that cause investors to buy more or less gold. I showed you this chart a few weeks ago in November. This is the way that we color it. We say right now, inflation and safe haven buying, they're moderate, they're neutral to positive. Currency hedge, form of savings, portfolio diversifier, alternative asset, those are all flashing green. Buy gold, buy gold, buy gold. And as a commodity, yeah, it's kind of flashing yellow. It's not negative. It's a relatively tight market because, again, investors, as I've said earlier in the year and repeatedly, investors tend to buy gold and hold gold. And when they're bearish on gold as a group on a net investment demand, you know, there are always investors buying and selling gold, but on a net investment demand, investors as a whole tend to be net buyers of gold in most of the years. 3 years since 1968, small net selling. But most years, investors, if they're not bullish on gold, they're buying less gold. And they're more bullish on gold, they're buying more gold. So that's important because what that tells you is that the current account, total newly refined gold entering the market from mines and from scrap recovery, has to meet not only fabrication demand, but also central bank demand and investment demand. And if you look at what's been happening in 2020, 2021, you're seeing it, central banks and investors buying more gold, pushing the price up because there's not sufficient amounts of newly refined gold readily entering the market to meet both fabrication demand and stock demand, investment demand, and central bank demand. That's probably going to continue in 2022, so it's going to be positive. And that's one of the things they're going to have to watch. I would not be surprised if we see all of these guys turning green in the first quarter of 2022. Not a happy note per se. It's a happy note if you're investing in gold, but it's kind of a cautionary tale if you're a human living in the real world. Buy our yearbooks. CPM Group's retail investment program allows smaller investors to plug into our research, get some of our research, have access to us through the open forums, send us questions. We get gold and silver trade recommendations, shorter term recommendations. You get the yearbooks as part of the retail investor program. There's an introduction to CPM Group available on YouTube, like a 5-minute video that talks about who we are. We have a lot going on next year, seminars, 4 seminars in the first 4 months of the year, 3 yearbooks in the first half of the year. And you can go to our site and read all about us. Have a good time, and we'll see you in 2022.